Hello students, welcome to the lecture on basic concepts of accounting, and after this lecture we will be able to learn the following objectives. Understand the meaning of accounting, explain the functions and nature of accounting, describe the role of the accounting, define the uses of accounting information, discuss the bookkeeping and accounting, explain the branches of accounting, understand basic accounting terms. Let's begin with a brief introduction to basic concepts of accounting. Every profit or non-profits business organization needs a reliable internal system of accountability. A business accounting system provides this accountability by recording all activities regarding the creation of monetary inflows of sales revenue and monetary outflows of expenses resulting from operating activities. The accounting system provides the financial information needed to evaluate the effectiveness of current and past operations. In addition, the accounting system maintains data required to represent reports showing the status of asset resources, creditor liabilities, and ownership equities of the business entity. In the past, much of the work required to maintain an effective accounting system involved extensive manual effort that was tedious, aggravating, and time-consuming. Financial accounting is concerned with the recording of financial transactions and analyzing the effect of such transactions to assist in the development of business decisions.
Hello friends. Today, we are going to understand the various accounting concepts. Our first concept is separate entity concept. According to this concept, business and businessman both are separate entity, and due to this concept, private transactions relating to the owners are segregated from transactions that relate to the business. It means that only business transactions are to be recorded in the books of accounts, not personal transactions of the owner. Now, next concept is realization concept. This concept says that income should be recognized at the point of sale or transfer of legal ownership of goods, not when cash is actually received. This concept is also known as revenue recognition concept. Now, let's see what materiality concept says. According to this concept, an accountant should record only material or significant items. Immaterial or low-value items should be either ignored or merged with other items. This will actually avoid accounting statements to be overburdened with the immaterial things. Now, our next concept is money measurement concept. This concept says that only those transactions which can be easily measured in terms of money are to be recorded. Transactions which cannot be measured in monetary terms, for example, honesty of employees, dispute between managers of two departments, are not recorded in the books of accounts. It means that accountants do not account for the items unless they can be quantified in monetary terms.
Let us now discuss the meaning of accounting. Over a period of time, a number of conventions, concepts have been postulated by various bodies interested in financial statements. Many of these are incorporated in the characteristics. These concepts are incorporated by pre-papers in current financial statements. Definition of accounting. American Institute of Certified Public Accounts, AICPA, which defines accounting as the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions and events which are in part at least of a financial character and interpreting the results thereof. Prudence. Prudence is a proper caution in measuring profit and income. Where sales are made for cash, profit and income can be accounted for in full. Where sales are made on a credit basis, However, the question of the certainty of profits or incomes arises. Consistency. This is one of the most useful concepts from the point of view of users who need to follow accounting statements through from year to year. Put simply, it involves using unvarying accounting treatments from one accounting period to the next, for example, in respect of stock valuation, etc. Money measurement. Whether in historic or current terms, money is used as the unit of account to express information on a business, and from analysis of the figures, assumptions can be made by the users. Cost. As money is used to record items in the business accounts, each item has a cost. Accountants determine the value of an asset by reference to its purchase price, not to the value of the returns which are expected to be realized. Business entity concept. The affairs of the business are distinguished from the personal affairs of the owners. Thus, a separate capital account is maintained in the business books, which records the business's indebtedness to the owners. Objective of accounting. Objective of accounting may differ from business to business depending upon their specific requirements. To keep systematic record, it is very difficult to remember all the business transactions that take place. To ascertain the results of the operation, accounting helps in ascertaining result, that is, profit earned or loss suffered in business during a particular period. Now moving on to the next topic, we will study the functions of accounting. The functions of accounting are record keeping function. The primary function of accounting relates to recording, classification and summary of financial transactions, journalization, posting and preparation of final statements. These facilitate to know operating results and financial positions. Legal requirement function. Auditing is compulsory in case of registered firms. Auditing is not possible without accounting. Thus, accounting becomes compulsory to comply with legal requirements. Accounting is a base, and with its help, various returns, documents, statements, etc. are prepared. Advantages of accounting. The following are the advantages of accounting to a business. It helps in having complete record of business transactions. It assists comparative study of current year's profit, sales, expenses, etc. with those of the previous years. It supplies information useful to judging the management's ability to utilize enterprise resources effectively in achieving primary enterprise goals. Limitations of accounting. Apart from the advantages of accounting, it has some limitations. Some of the important limitations of accounting are as follows. Focuses only on financial transactions or events while ignoring the non-monetary items. Leads to wrong conclusions if the assumptions of accounting data are inaccurate. Let's know the meaning of nature of accounting. In today's business, the current accounting system occupies a vital position and plays an important role in providing the business information to the users. As defined earlier, accounting is an information system that collects data of an organization and communicates it to a number of users who take decisions on the basis of this information. The accounting information can be useful in the following ways: provides information for taking financial decisions, fulfills the requirements of the users who rely on financial statements as their standard source of information for decision making. Role of accounting. Accounting plays a significant role in business operations by recording, analyzing, and communicating information of financial transactions. Let us define the role of accounting. Role of language involves maintaining and processing the financial information required by a business entity for its management and reporting purposes. The basic function of a language is to serve as a medium of communication. Role of information system involves collection and communication of financial information about an enterprise to the interested parties. However, accounting information is related to the past transactions and is quantitative and financial in nature. It ignores qualitative information and non-financial information. Role of historical records involves the recording of information in the form of a profit and loss account and balance sheet at the end of the financial year. Information provided in this manner serves as a historical record for an organization. It can be useful for various purposes such as evaluating performance, comparing the present performance of the organization with the past performance. The users of a financial statement include the present and potential investors, employees, lenders, suppliers and other trade creditors, customers, government and their agencies, and common people. It is unlikely that all the users would have common interests, and it is not possible to meet their individual requirements. However, these users play an important role in the business decision making. Therefore, it is necessary to classify them into groups and provide the information required by the respective groups, who further utilizes the information to take appropriate decisions. Internal users. The internal users of the accounting information are the members of the organization who work within the limits of the organization. These include the chief executive, the president, the vice president, the financial officer, business unit managers, plant managers, and line supervisors, who can be further categorized as owners, contribute capital to the business and thus are always exposed to risk. In view of the risk involved, the owners are always interested in knowing the profit earned or loss incurred by the business, besides the safety of the capital invested by them. In small and medium scale organizations, owners generally exercise direct control on the affairs and thus always require the information related to profit and financial position. Management involves managers who have the responsibility to manage business. As in a large-scale organization, ownership and management is separate. The management has the responsibility not only to safeguard the owner's investment but also to increase its value by managing the business efficiently to earn maximum profit. External users. The external users of the accounting information are the individuals or entities who are related to the organization in one way or the other, but they are not involved directly in the business operations of the organization. These are banks and financial institutions, provide loan to the organizations that are the main source for running the business. Creditors refers to those parties who supply goods or services on credit to an organization. It is an ordinary business practice adopted by a large number of suppliers. Before granting credit, creditors satisfy themselves about credit worthiness of the business. Government and its authorities make use of financial statements to compile national income accounts and other information. The information available enables them to take policy decisions. The government charges various taxes such as excise duty, VAT, service tax and income tax. The government authorities can access the correct tax dues from an analysis of the financial statements. Society refers to the environment, nature, and the people within which a business operates and grows. Organizations have a responsibility towards society and thus both directly and indirectly. It needs to contribute for the welfare of the society by protecting the environment, increasing employment opportunities, and providing educational facilities. Indirect contribution is not reflected in the financial statements but is visible through increased business activity and better infrastructure. Bookkeeping and accounting. Bookkeeping is one aspect that most business owners would love to involve themselves in. On the contrary, financial management is very crucial to sustaining and expanding a business. Without it, there is risk of hitting cash flow crisis, wasting money, scrambling for receipts, and facing other financial information issues that could lead to the closure of a business. Accounting, as an information system, is the process of identifying, measuring, and communicating the economic information of an organization to its users who need the information for decision making. It identifies transactions and events of a specific entity. Importance of accounting owners. The owners provide funds or capital for the organization. They possess curiosity in knowing whether the business is being conducted on sound lines or not, and whether the capital is being employed properly or not. Owners, being businessmen, always keep an eye on returns from the investment. Management. The management of the business is greatly interested in knowing the position of the firm. The accounts are basis. The management can study the merits and demerits of the business activity. Thus, the management is interested in financial accounting to find whether the business carried on is profitable or not. Creditors. Creditors are the persons who supply goods on credit or bankers or lenders of money. It is usual that these groups are interested to know the financial soundness before granting credit, the progress and prosperity of the firm to which credits are extended are largely watched by creditors from the point of view of security and further credit. Employees. Payment of bonus depends on the size of profit earned by the firm. The more important point is that the workers expect regular income for the bread. The demand for wage rise, bonus, better working conditions, etc. depend upon the profitability of the firm and in turn depends upon financial position. For these reasons, this group is interested in accounting. Consumers. These groups are interested in getting the goods at reduced price. Therefore, they wish to know the establishment of a proper accounting control, which in turn will reduce the cost of production, in turn fewer prices to be paid by the consumers. Researchers are also interested in accounting for interpretation. Importance of bookkeeping in a business. Accurate bookkeeping is a necessity for each and every business that has a vision to grow or stand out in the competitive market. Many businesses which would otherwise have been successful have been brought down by their failure to maintain proper financial records. Whether we like it or not, bookkeeping is very essential in a business. Importance of good bookkeeping services. For small business, many small business owners fail to recognize the importance of bookkeeping. Many believe that their current cash position is the only important financial measurement and they fail to recognize the critical data that is available in monthly financial statements. Bookkeeping services include customer billings, customer collections, vendor payables, payroll processing, and bank account reconciliation. Some important benefits of consistently maintaining the accounting records include improved revenue recognition and quicker conversion of accounts receivable to cash. Better measurement of spending, allowing for better cash management.
What I'm going to do is give you 6 really good best bookkeeping practice tips today for you to make sure you follow. Number 1 is to be organized. You must be able to get your hands on your source documents at all times. Number 2 is to have an audit trail for every transaction that you post. Number 3 is to make sure you're using a computer software program. The reports that come out of the software programs are very detailed and will give you the information that you need to move forward. Number 4 is reconciling your bank statements and credit card statements and vendor statements every month. Make sure you keep on track. 5 would be to comply with all Revenue Canada document retention requirements, which is 7 long years. You need to keep those receipts. And number 6 would be to file all of your Revenue Canada remittances on time. Payroll, HST, and of course corporate taxes or installments going forward. If you follow these practices, you will have a plan in place for when cash flow gets tight, and it will that first year in business. You'll also be able to use those reports to grow your business and make financial decisions going forward. Those reports will become the lifeblood of your business.
Branches of accounting. Accounting is a very old science which aims at keeping records of various transactions. The accounting is considered to be essential for keeping records of all receipts and payments as well as that of the income and expenditures. Accounting can be broadly divided into 3 categories. Financial accounting aims at finding out profit or losses of an accounting year as well as the assets and liabilities position by recording various transactions in a systematic manner. Cost accounting helps the business to ascertain the cost of production, services offered by the organization, and also provides valuable information for taking various decisions and also for cost control and cost reduction. The definition given above is self-explanatory. However, for understanding clearly, the following terms are explained. Business transactions. A transaction means an activity. A business transaction means any activity which creates some kind of legal relationship. Classification of transactions. Before recording any transaction, it is essential that it is to be classified. Cost accounting. It is a type of accounting process that aims to capture a company's costs of production by accessing the input costs of each step of production as well as fixed costs such as depreciation of capital equipment. Cost accounting will first measure and record these costs individually, then compare input results to output or actual results to aid company management in measuring financial performance. Basic accounting terms. Every subject has certain important basic terms, and accountancy is no exception. Trading and non-trading business items. One must have visited many business concerns. It might have noted the various items that are purchased for further sale by the business concerns. Trading items. Trade means purchase and sale of goods or services. And goods or items which are purchased by the businessman in order to sell them, thereby earn profit, are called trading items. A business concern deals in trading items in the stationery shop. Books, pens, pencils, etc. are all trading items. Non-trading items. Items which are purchased by the business concern in order to use them are called as non-trading items. Now in the end, let us summarize what we have learnt in this lecture. Information system is the process of identifying, measuring and communicating the economic information of an organization to its users who need the information for decision making. Revenue refers to the inflow of money or other assets that result from the sale of goods or services or from the use of money. The purpose of management accounting in the organization is to support competitive decision making by collecting, processing and communicating information that helps management plan, control and evaluate business processes and company strategy. The primary function of accounting relates to recording, classification and summary of financial transactions, journalization, posting and preparation of final statements. These facilitate to know operating results and financial positions. Financial accountancy is the field of accountancy concerned with the preparation of financial statements for decision makers such as stockholders, suppliers, banks, employees, government agencies, owners and other stakeholders.